We do have some stuff on our calendar this week, including some earnings. Of course, that means the banks as well. We've got Goldman earnings. We've got BlackRock earnings. I've got Caroline Woods joining me here this morning as we look at some of the big moves. We talked Apple earlier. Sales in India are improving. Market likes that, but also big price target hike on Apple to $300. Caroline's at the New York Stock Exchange. Caroline, let's talk some banks to start. What do we got?
Well, we have Goldman Sachs higher after a beat on both the top and bottom line. Shares up 1.6%. We know Goldman's been undergoing this strategy shift away from consumer loans and back to its really core business of deal making and trading, and that seems to be working. Earnings per share came in at $8.62. The estimate was for $8.52. That was a 150% jump from the year ago period. Of course, they were impacted back then by write-downs tied to commercial real estate and also the sale of that consumer business. Revenue, meanwhile, rose 17% to $12.73 billion. The estimate was for $12.6 billion. Breaking it down by segment, global banking and markets was up 13.8%, asset and wealth management up 27.3%, and then platform solutions up 1.5%. In terms of some of the highlights, fixed income revenue rose 17% to $3.18 billion. That came in higher than Wall Street was looking for. Provision for credit losses in the quarter fell 54% to $282 million, significantly below Wall Street's estimates of around $435 million. As I said, they're shifting away from that consumer lending business. Equities trading rose 7% to $3.17 billion. That was in line. Investment banking fees rose 21% to $1.73 billion. That was actually slightly below what Wall Street was looking for. They were looking for around $1.8 billion, and quite a bit lower than we saw in terms of fees from JP Morgan and Citi as well. So taking a look at shares, they're up about 1.3% on the back of these results. So investors kind of looking past those the lower fees and focused on the top and bottom line beat, it seems.
Wow. All right. Gains better than last week as we started with JP Morgan and pretty much everybody down. The fact that the market's up broadly too certainly doesn't hurt, but it does also kind of seem like a better report with the dividend. Like it seems a little bit more kind of hitting on all cylinders in a way, and a little bit I think a market too for the quarter that was a little bit more geared towards like a capital markets focused, trading focused, IPO focused bank, right? It was, folks at the NASDAQ were telling us every time we do our hit there how active. It was a good quarter for IPOs, so that type of stuff is more in Goldman's neighborhood than a Citi or rather a Wells Fargo, Bank of America like last week.
Right, certainly. Deal making, it's certainly not back, but it's certainly better than last year. So better comps, and we saw it reflected in these results.
Yeah. All right. BlackRock. Look, index is making all-time highs. What couldn't be good for BlackRock in that scenario? There's not a lot of scenarios that are bad for BlackRock.
Well, it's actually lower right now, down about 0.2%, because this was actually a mixed report. It was a bottom line beat, but a top line miss. The world's largest asset manager posted adjusted EPS of $10.36. Easy beat compared to the $9.96 that analysts were expecting. Revenue did rise almost 8% to $4.81 billion, but the estimate was for $4.86 billion. So miss there. Revenue from technology services jumped 10% to $395 million. Now, total assets under management came in at $10.6 trillion. That's up $1.2 trillion year over year, driven by consistent organic growth and positive market movements. Total net inflows of $81.57 billion was up slightly from $80.16 billion in the year ago quarter. You talked about those exchange traded funds. Those captured the majority of flows, $83 billion, led by fixed income and core equity ETFs. BlackRock actually said ETF flows of $150 billion in the first half of 2024 represents BlackRock's best start to the year in iShares history, and more than double what they were in the first half of last year. CEO Larry Fink said BlackRock is executing on the broadest opportunity set we've seen in years, including in private markets. In terms of fees, investment advisory and administration fees rose 8.6% to about $3.72 billion. In terms of the actual funds, also wanted to point out their Bitcoin ETF reached nearly $20 billion in the first 6 months of the year. That's the third highest grossing exchange traded product in the industry this year, according to BlackRock. So taking a look, shares down about 0.2% right now, only up about 2% year to date. So not seeing a whole lot of movement here, but it was a mixed report because revenue did fall, or I'm sorry, revenue rose but fell below analyst expectations.
Okay. All right. High expectations when it comes to BlackRock. So I hear you on that. Don't think there's like a lot of meat behind the sell-off, and it's already kind of coming back here within basis points. Let's talk some tech. We got, hold on, before we go to tech, let's talk to Macy's latest with Arkhouse. Take me through that, Caroline.
Well, Macy shares are sinking about 14% right now after ending buyout talks with Brigade and Arkhouse after really months of negotiations. Macy's board said that their discussions failed to lead to an actionable proposal with certainty of financing at a compelling value. So Arkhouse and Brigade initially reached out to Macy's in December of 2023, so about 7 months ago, expressing interest in acquiring the company. They were looking to take the retailer private for about $6.9 billion, but apparently couldn't get past some of these issues with financing and premium. Macy's board said, "We have concluded that Arkhouse and Brigade's proposal lacks certainty of financing and does not offer compelling value." So the board intends for the management team to return its full focus to enhancing shareholder value through the execution of the company's A Bold New Chapter strategy. So as I said, Macy's share is down about almost 15% right now. They were already negative year to date, but now down about 19% year to date. So really taking a hit on the news that this deal is no longer.
Okay. Yikes. Break it down kind of in a big way, you know, like it also does sort of like put a little bit of a damper on kind of the sector for some of the big box beaten down kind of struggling retailers too, because the whole Macy's takeout thing was kind of like a premium that was sitting over the whole category as it out, right? Like a possible outcome for some of the stressed mall-centric and just kind of stressed big real estate-driven retail plays. So the fact that that's not going to happen, I don't know. I'd be like watching out for like Nordstrom, Kohl's too. I don't think it's a good message for really any of them, but I don't know. I might be getting ahead of myself there. All right, now let's talk some tech. We got Nvidia, we got Google. A little Nvidia price target hike. Let's talk about that for a sec.
Well, Nvidia shares up about 0.5% right now and got another price target bump, this time from TD Cowen. It seems like every day we have a new price target hike for Nvidia to talk about. The analyst at TD Cowen raised his price target on Nvidia to 165 from 140. So, you know, Nvidia's trading just around 130 right now, so about $35 upside. That was 28% upside from Friday's close. In terms of the analyst also, of course, reiterated his buy rating. He thinks that demand for AI systems Blackwell and Hopper will remain robust, saying one thing remains the same, fundamental strength at Nvidia. In fact, our checks continue to point to upside in data center as demand for Hopper Blackwell-based AI systems continues to exceed supply, saying overall we see a product roadmap indicating a relentless pace of innovation across all aspects of the AI compute stack. So TD Cowen also thinks Nvidia will beat Wall Street's estimates when it reports Q2 results on August 15th. Expects Nvidia will also raise its outlook thanks to that strong data center demand. So we heard similar sentiment from KeyBank last week when they were saying they expect upside to the results and to guidance, and said despite the fact that Blackwell is going to be released in the second half of 2024, they're not seeing any signs of a demand pause as demand for the H100 remains robust and they continue to see rush orders. So very similar sentiment to what we heard from them. Nvidia shares up about 0.7% right now.
There was also a commentary in a Financial Times article from someone that I've never heard of, but they're reporting on James Anderson, who apparently was an early investor in Tesla, Amazon. They had like a whole piece about how Nvidia is going to be worth $50 trillion. So that, you know, we're in that state. That's where we're at for markets. The animal spirits are raging $50 trillion in a decade. So All right, that's usually when things start getting a little bit crazy, but okay. That's the vibe that's out there, the tone that's there. Carolina, last thing real quick, Alphabet, potentially for a pretty big acquisition. Kind of a fun little story here.
Yeah, if it can actually happen. But
Right.
Alphabet shares actually looks like they might open lower, but actually up about 1% on news that it's in advanced talks to buy cybersecurity firm Wiz for $23 billion. That's according to the Wall Street Journal. It would be Alphabet's largest acquisition ever. And the deal could come together soon, according to the Journal. Reuters then reporting that the deal is actually being funded mostly in cash. So in terms of Wiz, it was founded in 2020. It offers cybersecurity software for cloud computing. So the acquisition could help boost Alphabet's cloud computing efforts. We know they've been lagging behind some of their competitors in that space. The $23 billion reported price tag, that just to kind of put things into perspective, Wiz raised $1 billion earlier this year at a valuation of $12 billion. So it was one of the only a few startups outside the AI industry to raise money at a higher valuation in 2024. It was actually considering going public as recently as May. So obviously this could change those plans. But I think the big question, though, is can this deal even go through in terms of if the deal goes through, will the regulatory landscape allow for that, the regulatory inspection? Because we know that the Justice Department has really increased its antitrust scrutiny, especially any deal that has Alphabet attached to it. So
Totally.
A little bit of optimism today. Shares up about almost 1% right now.
Yeah, really good point. That is going to be quite a balancing act if they're able to do their biggest acquisition ever with already so much antitrust scrutiny in a realm that is certainly, arguably, going to give them even more kind of like power and reach. So it's, not a totally separate field. It's not like, obviously it fits within the wheelhouse to some degree, but then kind of builds on it too. So it's really interesting. And the share is up on it too. I mean, market seems like they want it to happen. Are you a Seinfeld fan, Caroline?
Not a whole lot of conviction, though, with an 0.8% gain right now. And also, it's an election year. We could see kind of a different regulatory environment if we look ahead. So, I don't know. 0.7%. We'll see.
It's hard for me not to make a Seinfeld joke with the Wiz stuff, like the Wiz. The Wiz. But, all right. Okay, we'll move on. All right, thanks, Caroline.
I would understand that more than I would your Greek mythology.
There you go. All right, okay, cool. So nobody buys the Wiz. All right, $23 billion might get the job done, though. All right, thanks, Caroline Woods from the New York Stock Exchange. Appreciate the look there at some of the movers here this morning.